Good day, fellow investors. One of the requested stocks for me to look at was McDonald's, which is definitely a great business. And a great business is also reflected usually in a great stock price performance. But if you look at the data a little bit lower, you can see that we are now trading close to 52-week lows. And then many ask, okay, is it now a good time to buy? Is it cheap? But you can see that these 52-week lows are not that relevant compared to what has happened over the last 2 decades for McDonald's, which is stellar performance. But people still flock to it, so it is a good time to look at the business. They are growing. If you look at their presentation, then they are just continuing with their investments globally, capital allocation, great free cash flows. They do everything right when you look at the business. Of course, location, location, location. Nothing wrong with the company. So accelerate net unit growth by 4%, 5% growth in 2027. And wherever they open, then you can see here that it is a trend and people simply have built a habit of going there that improves margins. They are going more into franchised, which means better margins for the business, less risk. And therefore, if you look at the business, I cannot find anything wrong with it. I never go there, but I'm also overweight, so you cannot blame McDonald's for being overweight. Anyway, apart from the jokes, what I wanted to discuss here is the following. Stock price, as we said, just going up and up. Now a little bit of weakness, but we have to see what's going on. And we see this with such companies with the P ratio. The P ratio for a restaurant company was usually around 10, 15, but now it expanded to around 20, which is still cheaper than the S&P 500 and relatively cheaper than many other companies and cheaper than what it was a while ago, especially given the great earnings last year. However, if we look here, the company did what it planned to do. There are some weaknesses, always times with weakness, of course, the pandemic, and then that will be always there. But you see how they deliver. Over a decade, a little bit more, earnings doubled a little bit more. So what is that? 5, 6, 7% earnings growth on that. Add to the dividend of 2%. Let's say they grow on average 6% going forward, but that is it. 5% net storage growth, inflation 2%, dividend 2%. And you can still get a 10% return from McDonald's even from these levels. However, the key risk, and that's what we discussed yesterday, is valuation. Because if valuation goes from 20 to 10, 12, it halves, then it just adds another decade for you to get those returns apart from the dividend. I just want to explain this in detail. The current situation with McDonald's is the P ratio is 22. Earnings per share are at 11.77 and the stock price is 259. In case, let's say over the next decade interest rates remain higher due to whatever, and then the P ratio goes down to 11, so it halves. In the meantime, McDonald's just keeps on doing what they have been doing in the past and doubles earnings per share to 22. Then, in 2034, the stock price, P ratio of 11, double the earnings of 22, the stock price ends up at 242, which means from a stock price perspective, you're looking at a negative return in 2034. Of course, the dividend that's now 2.5% would likely grow as earnings double to 5%. Thus, on average, you'll get a 30-40% return over a decade. Not bad, but not stellar. However, much better than many other things out there that are people owning these days. If there is some issue with McDonald's negative marketing, like it has been the case its ebbs and flows, then it goes lower. So I think McDonald's is a good business, stable business. We are not going into how healthy it is, but it is there, it is expanding, it has a strong brand, it is becoming a habit of people, and therefore you cannot say anything wrong about the investment. Dividend yield, inflation growth, so protection from inflation, because if the dividend yield is 2.5 and they can increase prices by 3%, you're already 5.5%, and then if they grow at 4%, 5%, that's a 10% return from investment, even at these levels. And that's it. If the return on capital keeps on being positive, if they just keep doing what they are doing, that's the expected return, and that has been the case over the last 20 years, as we can see here on the stock price. Their locations are staggering and they just keep on delivering. So I cannot say it's bad. I cannot say it's a negative or it's too expensive. I think it's a strong brand, stable, stalwart business. It's better to buy them on the cheap P ratios of 10, but if you want to start a position and then if it goes lower, accumulate over time, I think that over 20 years you will get to a good return from this. I'm not going to follow, maybe if it gets to a P ratio of 10. I remember McDonald's is one of the first stocks I looked here when it was trading at $19 when I started investing. So that's something, but okay. Anyway, not much to add. Everything is known about the company, and these are the data. Simple investment, and as I always say, just see how it fits your portfolio and your financial goals. Thanks for watching. I'll see you in the next video.